90% of small account traders fail because they chase massive gains. They end up blowing their accounts, trying to double their money fast. Let me show you the fastest and the safest way to grow a small account when day trading. Aim to make 1% of your account each day through 2 or 3 well-planned trades. This should add up to at least 10% monthly when compounded, making it realistic for small accounts. I said 10% and not 20 because let's face it, you won't end every day on profit. But a 10% gain on a month is doable if you follow all these rules. You see, many traders fail because they chase big wins right from the start. They see a YouTuber flashing his rented car. They believe he turned $100 into $500,000 in a few months. So they enter into gambling state. You're better than that. Instead of aiming for huge gains, split your daily target into 2 or 3 trades. Each trade only needs to bring in a small profit to reach your goal. This simple approach will keep your emotions in check and prevents the common mistake of overtrading. You need a solid foundation first. I know a steady 1% daily gain might sound small, and I repeat, you won't hit it every day, but money grows faster than you think when you let compounding work its magic. Your small account can expand without taking crazy risks that blow up your account. The best part is that you don't need to catch every big market move. While others chase the next hot stock, you can focus on finding small, repeatable patterns that consistently deliver modest profits. Use small contract sizes if needed. There's no shame in starting super small while you prove your system works. Your account size shouldn't change how you trade. Whether you have $1,000 or $10,000, stick to this 1% profit rule. This keeps you safe as your account grows and stops you from getting overconfident with bigger positions. The truth is most traders struggle because they don't treat this like a real business. They jump in and out of trades randomly, hoping to get lucky. But consistent profits come from having a specific plan. And you need to stop trading once you hit your daily target. This is important. Many traders give back their gains by getting greedy. If you make your 1% goal in one trade, great, pack it up and come back tomorrow. When you start with minimal position size, but after reaching a 20% account increase, you start to increase your lots or contracts slightly. This progressive scaling matches account growth with position size. A small account means being smart about position sizing. You'll want to begin with the smallest possible lot size, typically micro lots in Forex or minimal shares in stocks. This approach protects your capital while you build consistency. Instead of rushing to trade bigger positions, you first prove you can make steady profits with minimal risk. This keeps you in the game long enough to actually grow your account. The beauty of lot scaling lies in its natural progression. You start with micro positions where even a bad trade won't hurt much. And once your account grows by 20%, you can slightly increase your position size. This means your risk stays proportional to your account size. You're not suddenly taking massive positions just because you had a few good trades. Many day traders make the mistake of increasing their position size too quickly after a winning streak. This often leads to wiping out all previous gains with 1 or 2 bad trades. You know what I'm talking about. We've all lost all our previous gains with one impulsive bad trade. Smart scaling prevents this common pitfall by keeping your risk consistent with your account growth. Your trading setup doesn't change, only the position size does. If you're trading successfully with 1 mini lot, you'll use the exact same strategy when you move to 2 mini lots. The key to successful lot scaling is patience. You might spend several months trading the smallest position size before increasing it. This isn't wasted time. It's building a solid foundation for larger future trades. Position sizing should match your skill level, not just your account size. Even if your account grows quickly, stick to smaller positions until you've proven consistent profitability over time. Scaling up too fast can be just as dangerous as not scaling at all. It's better to use smaller position sizes than your account would allow, preferring the safety and peace of mind that comes with conservative position sizing. The goal isn't to reach the largest possible position size. It's to grow your account steadily while keeping risk under control. This one is obvious. Set profit targets at least twice your risk on each trade. If risking $50, aim for at least $100 profit. This positive risk-reward ratio helps small accounts grow, even with a 40% win rate. So for every dollar you risk, you aim to make at least $2 in profit. This simple rule shifts the odds in your favor, even if you lose more trades than you win. Most traders get this backwards. They grab tiny profits, but let their losses grow too big. This kills small accounts fast. The right way is to flip this around, to keep your losses small and let your profits run until they're double your risk. The beauty of this approach shows up when you have losing streaks, and everyone has them. You can be wrong more often than right and still make money. This rule keeps your emotions in check too. You know exactly where you're getting out, win or lose, before you even enter the trade. You see, many traders think they need to win most of their trades to make money, but that's not true at all. With a 2-to-1 profit target, you can lose 6 trades and win 4 out of 10, and you'll still end up in green. This takes enormous pressure off each individual trade. Day trading isn't about perfection. It's about giving yourself room to be wrong while still making money. Stop trading after 3 consecutive losses in one day. This preserves capital and prevents emotional revenge trading that often follows losing streaks. Day trading needs clear stopping points to protect your money and your mind. This 3-strike rule acts like a safety net. After 3 losses in a row, you step away from the screen. New traders often fall into a dangerous trap after losing trades. They try to win back their money right away, trading bigger or taking risky setups they normally wouldn't touch. But 3 consecutive losses signal something's off, either with the market, your strategy, or your mental state. The power of this rule shows up in your account balance. Instead of turning a bad morning into a terrible day, you preserve your capital for tomorrow. Markets open every day. There's no need to force trades when things aren't working. Most trading mistakes happen when emotions take over after losses. This is almost guaranteed. You will start revenge trading. You will start taking trades outside your plan just to get back at the market. Small accounts can't handle big drawdowns, so you need firm rules about when to stop. When you have a solid risk management, 3 losses might cost you 1 or 2% of your account. But without this rule, an emotional spiral could cost much more. Day trading isn't about being in the market all day. Some days, the market just won't match your strategy, and that's fine. The 3-strike rule gives you permission to step away and save your money for better opportunities. When in profit, at 1-to-1 risk-reward, try to move your stop to break even if the price action allows it, and let the trade run. In day trading, preservation comes before profits, and moving your stop loss to break even stands as one of the smartest ways to protect your small account. This means shifting your stop loss to your entry price once the trade moves in your favor, making sure you don't turn a winning trade into a losing one. Day trading must start with shifting your mindset from chasing profits to protecting what you have. Most traders burn their accounts because they focus only on potential gains. But good traders flip this thinking upside down. They obsess over protecting their capital first. Every trade begins with, how much could I lose? Instead of, how much could I win? Growing a small account starts with you becoming a break-even trader. This means learning to protect your capital while gaining real market experience. Think of break-even like a safety net in trading. The trade becomes free. You can't lose money anymore, but you still have all the upside potential. Of course, the timing of moving to break-even matters a lot. Many traders make the mistake of moving their stop to break-even too quickly when they see a small profit. This often leads to getting stopped out right before the market makes its real move. Wait for price to prove itself by reaching that 1-to-1 mark first. Trade half your normal size when testing new markets or strategies. Only increase after 10 successful trades. This simple rule helps you avoid costly mistakes that come from jumping in too big, too fast. The reality is that everyone makes mistakes when testing new strategies, and we all like to test new concepts and new ideas. But many traders don't adjust their positions because they're eager to make money fast. After all, a new strategy is still untested. You don't want to enter with full positions. Half positions let you gain real market experience while keeping your risk small. And don't rush to increase your size. Wait for at least 10 profitable trades before thinking about trading bigger. Those 10 trades aren't just about making money. They show you how that new strategy handles different market conditions. You might face fast markets, slow markets, news events, or different levels of volatility. Half positions let you learn from all these situations without taking big hits to your account. And let's face it, that new strategy might come with more losing trades. Trading half size means these losses won't hurt as much. Trade only the first 3 hours of the session when volatility and opportunities are highest. This prevents overtrading during slow periods. Trading the start of the session gives you the best mix of volatility and opportunity. It doesn't matter if it's the London session or the New York one. The first 3 hours of the sessions are the sweet spot for active traders. The sessions pack more action because big players are setting up their positions for the day. This creates the perfect environment for small account traders to catch strong moves. You see, many new traders make the mistake of sitting at their screens all day. But here's the thing. It's better to work when the market is most active. The early session brings more volatility, which means faster moves and better profit potential. After these first 3 hours, many markets slow down as institutional traders head to lunch or get caught up in meetings. Trading during these slower periods may lead to forced trades. The morning session gives you the best chance to catch meaningful moves. A structured morning routine helps you prepare for these important trading hours. Before the start of the session, you should look for potential price levels and setups. This preparation lets you act quickly when real opportunities show up. Again, trading only the morning session also protects you from the common mistake of overtrading. When you know you only trade during specific hours, you will become more selective with your setups. Calculate the average daily range and only take trades in the first 70% of that range. This prevents late-day choppy trades. An underrated part of day trading is being on the right part of the daily range. Markets follow a predictable pattern. They usually make their biggest moves early in the session. These moves build up to create what we call the daily range, which is the difference between the highest and lowest prices of the day. I advise you to focus on the first 70% of this range, where the strongest price movement happens. In the early parts of the daily range, you'll find the cleanest moves because that's when institutional traders are most active. The math behind this is straightforward. You look at the previous few days' ranges and find the average. There are many TradingView indicators that can show the daily range. This gives you a good idea of how much the market typically moves in a day. Once price has moved about 70% of that average range, the quality of trades often drops significantly. You see, trading small accounts requires extra care with risk management. By limiting yourself to the first 70% of the daily range, you're trading when the market is most predictable. After this point, the market often becomes choppy and less directional. Many traders make the mistake of chasing trades late in the range. But here's what happens. After the market has made its main move for the day, price action becomes more random. This randomness creates false signals that can trap inexperienced traders. The daily range strategy works especially well for small accounts because it keeps you focused on high probability setups. Instead of trying to squeeze trades from a tired market, you concentrate your efforts when price movement is most reliable. Remember that day trading gives you lots of opportunities, but these opportunities aren't equally distributed throughout the day. The best moves happen within that first part of the daily range. This approach also helps prevent overtrading. Once you've identified the average daily range, you know exactly when to be active and when to step back. This discipline protects your small account from unnecessary losses during choppy market conditions. You can see this principle at work in any market. Take Amazon stock as an example. You might catch a clean move in the morning when the stock is making its primary move for the day, but trying to trade the same stock after it's moved through most of its daily range often leads to frustration and losses. Exit any trade that hasn't hit profit target within that day. This prevents getting stuck in non-moving positions or future market gaps. Time stops rank among the most effective tools, especially with a small account. The basic idea is simple. If a trade isn't working within a set time, you exit. This keeps your money from getting stuck in trades that go nowhere. You already know this. Most of your winning trades, it showed their potential quickly. When you enter a trade and it just sits there, doing nothing, that's often a sign that your timing wasn't quite right. Professional traders know something that beginners often miss. Your trading edge exists because you spotted a market imbalance. That imbalance should create price movement pretty quickly. When the market just sits there after your entry, your trade lacks momentum. Day traders often fall into the trap of waiting too long, hoping a trade will eventually work out. So they wait. They turn a one-day trade into a swing trade. The problem is they focus too much on entries and forget about common sense exit strategies. With a small account, you can't afford to let your money sit idle in trades that aren't moving, even if your stop wasn't hit. Every minute your money sits in a non-moving trade is costing you potential profits elsewhere. You need your capital free to take advantage of real opportunities, not tied up in trades going sideways. There are two smart ways to use time stops. You can either exit at market price when the day ends, or you can move your stop loss very close to the current price when in profit. The second approach gives the trade a tiny bit more room while still protecting your capital. Remember that markets move in bursts. The best trades often work quickly, showing momentum and clear direction. Think of time stops as a way to keep your trading focused and efficient. You're in the market to catch moves, not to watch your money sit idle. And for maximum protection, you should close your trades before major economic news. Small accounts can't handle news volatility. Your safest move is to close trades 5 or 10 minutes before any significant news release. For really big events like interest rate decisions, you might want to close even earlier. This prevents you from getting caught in the extreme volatility that news can create. It may be tempting to let your trade run during these conditions. It might even help your position. But think about news trading like driving in extreme weather. Sure, you could do it, but why take the extra risk? News creates slippage, meaning your stops might not fill at the prices you expect. Your 20 pip stop loss could turn into a 40 pip one. This becomes especially dangerous with a small account where every dollar counts. Only take trades that align with the daily trend. Trading with higher time frame confirmation stands as one of the smartest approaches for small account growth. The daily trend acts like a roadmap, showing you the safest path for your trades. Patterns that work with the daily trend direction have higher win rates and produce cleaner moves. With a small account, you can't afford to take many losing trades, so this edge becomes extremely valuable. Trading in the direction of the daily trend puts the big institutional money on your side. When you spot a setup on a smaller time frame that matches the daily direction, you're essentially riding the coattails of larger players. A key insight many traders miss is that counter-trend moves tend to be shorter and more unpredictable. While you might see impressive counter-trend runs on smaller time frames, they usually end up feeding back into the main trend. This makes fighting the daily trend a dangerous game for small accounts. So use multiple time frames to fine-tune your entries. You might spot a pattern on a lower chart, but checking the 4-hour or the daily trend helps confirm if it's worth taking. The best trading opportunities often appear when multiple time frames align. Think of it like layers of confirmation. When your shorter-term trading signal matches the daily trend, you are stacking probabilities in your favor. This becomes especially important when trading with limited capital. Position sizing represents the cornerstone of risk management in trading. Such calculator, like this one on my FX book site, will help you protect your capital and maintain consistent risk across all trades. Let's say you have a $1,000 account, risking 1% per trade, and let's say your stop loss requires 50 pips. The calculator shows you should trade 0.02 lots, which means you'll risk $10, 1% of the account. This calculator prevents emotional decisions. Instead of randomly picking trade sizes, it does the math for you. With a $1,000 account, risking $10 per trade, which is 1%, means you can withstand many losing trades without damaging your account. This systematic approach prevents the common mistake of randomly choosing position sizes or over-leveraging your account. This calculator enforces discipline. The beauty of this system is its scalability. As your account grows, your position sizes will automatically increase while maintaining the same percentage risk. This allows for steady, controlled account growth without taking excessive risks that could damage your capital. For small account traders, this calculator becomes even more critical. A small account has no room for error, and one oversized position can wipe out months of careful trading. Using exact position sizes removes emotion and guesswork from your trading decisions. To grow a small account, you need a mechanical trading strategy. That's why you need to focus on creating repeatable, systematic processes rather than discretionary trading. A mechanical strategy means you define exact rules for everything. You spot a specific signal, you check specific conditions, and you take the trade if everything lines up. No guessing, no hoping, no emotional decisions about feeling good about a trade. Your strategy needs clear rules for when to enter, where to place your stop loss, and how to exit with profit. Without clear rules, you'll find yourself making different decisions each time, which destroys consistency. The power of mechanical trading shines during tough market conditions. For your small account, the strategy needs to be simple. You might start with a basic support and resistance, or supply or demand strategy with clear rules. You buy when price bounces off a key level with a specific candlestick pattern. Sell when price hits resistance. Simple but effective when followed consistently. The hard truth about mechanical trading is that it feels boring. You might watch the market make moves without taking trades because your specific conditions aren't met. This is good. Trading should feel like operating machinery, not like gambling at a casino. Many traders resist mechanical trading because it removes the excitement. They want to feel smart by making discretionary decisions. But with a small account, you can't afford this luxury. Every decision must come from your pre-planned rules. Each trade must follow the exact same process, regardless of how you feel about the market. Your mechanical rules protect you from the biggest enemy in trading, yourself. When real money moves at stake, we tend to make emotional decisions. A mechanical strategy acts as a shield against these emotional impulses. So start by writing down every rule of your strategy. Entry conditions, exit conditions, position sizing. Everything must be specific enough that another person could follow your rules and get the same results. The goal is to find a simple, repeatable process that gives you a small edge, then execute it flawlessly through mechanical rules. Now, if you want to learn other day trading strategies, go ahead and watch one of these videos next.